Okay, I'm reading out of the IRS Publication 590. I presume I'm on page 41. Are distributions taxable? In general, distributions from an IRA are taxable in the year you receive them. We have a section on failed financial institutions, exceptions, which are rollovers, qualified charitable distributions, and tax-free withdrawals of contributions. And actually, I have read this section because in general, qualified contribution distribution, charitable distributions, could have been made in 2013 that were still for 2012, and how to report that. I think I ended at one-time qualified HSA funding distribution. Now that I think about it, you may be able to make a qualified HSA funding distribution from your traditional IRA or Roth IRA to your health savings account. You cannot make this distribution from an ongoing SEP IRA or simple IRA. For this purpose, an SEP IRA or simple IRA is ongoing if an employer contribution is made for the plan year ending with or within your tax year in which the distribution would be made. The distribution must be less than or equal to your maximum annual HSA contribution. This distribution must be made directly by the trustee of the IRA to the trustee of the HSA. The distribution is not included in your income, is not deductible, and reduces the amount that can be contributed to your HSA. You must make the distribution by the end of the year. The special rule allowing contributions to your HSA for the previous year, if made by your tax return filing deadline, does not apply. The qualified HSA funding distribution is reported on Form 889 Health Savings Accounts for the year in which the distribution is made. One-time transfer. Generally, only one qualified HSA funding distribution is allowed during your lifetime. If you own 2 or more IRAs and want to use amounts in multiple IRAs to make qualified HSA funding distribution, you must first make an IRA to IRA transfer of the amounts to be distributed into a single IRA, and then make the one-time qualified HSA funding distribution from that IRA. More information, see Publication 969 Health Savings Accounts and Other Tax-Favored Health Plans for additional information about this distribution. Ordinary income. Distribution from traditional IRAs that you include in income are taxed as ordinary income. No special treatment. In figuring your tax, you cannot use the 10-year tax option or capital gain treatment that applies to lump sum distributions from qualified retirement plans. Distributions fully or partly taxable. Distributions from your traditional IRA may be fully or partly taxable depending on whether your IRA includes any non-deductible contributions. Fully taxable. If only deductible contributions were made to your traditional IRA or IRAs, if you have more than one, you have no basis in your IRA. Because you have no basis in your IRA, any distributions are fully taxable when received. See reporting and withholding requirements for taxable amounts. Later, partly taxable. If you made non-deductible contributions or rolled over any after-tax amounts to any of your traditional IRAs, you have a cost basis investment in the contract equal to the amount of those contributions. These non-deductible contributions are not taxed when they are distributed to you. They are a return of your investment in your IRA. Only the part of the distribution that represents non-deductible contributions and rolled over after-tax amounts to your cost basis and rolled over have been made or after-tax amounts have been rolled over to your IRA. Distribution consists partly of non-deductible contributions basis and partly of non-deductible contributions, earnings, and gains, if there are any, until all of your basis has been distributed. Each distribution is partly non-taxable and partly taxable. Form 8606. You must complete 8606 and attach it to your return if you receive a distribution from a traditional IRA and have ever made non-deductible contributions or rolled over after-tax amounts to any of your traditional IRAs. Using the form, you will figure the non-taxable distributions for 2013 and your total IRA basis for 2013 and earlier sales. See the illustrated forms 8606 in this chapter. Note, if you are required to file Form 8606, but you are not required to file an income tax return, you still must file Form 8606. Complete Form 8606, sign it, and send it to the IRS at the time and place you would otherwise file an income tax return. Figuring the non-taxable and taxable amounts.